All right, so we are discussing the reversal of an impairment loss, and this is the most important thing within IAS 36. But before getting into the reversal of an impairment loss, we need to understand the idea first. And the idea is that when we did the revaluation, the upward revaluation, the double entry was like debit asset, and debit is accumulated depreciation if it's a depreciating asset, and credit revaluation surplus. This was the double entry when we did the revaluation. And then we had an impairment loss. When we had an impairment loss, we said that first of all, you have to reverse the revaluation surplus of this asset. If still there is any impairment loss left, then you're going to charge it to the profit or loss, and credit goes to the asset. So if there is an impairment loss related to an asset which was previously revalued, then first of all, you have to reverse the revaluation surplus. If still there is any impairment loss left, then you're going to charge it to the profit or loss, and credit goes to the asset. Now, carrying the same idea again, that impairment is dependent on the indicators. Impairment is dependent on the indicators, whether internal or external. You already know that from the previous slide. Now, the idea is, what if those circumstances, those events which caused the impairment has now reversed? It is possible that based on the indicators on which you have charged the impairment, those factors, those events, those circumstances has now been reversed. If those factors have now been reversed, then you need to reverse the impairment loss as well. So the calculation of impairment losses is based on the prediction, that means in the indicators of what may happen in the future, because it's an accounting estimate. Sometime actual events turn out to be better than predicted. Now the factors based on which you have charged the impairment may reverse. If this happens, the recoverable amount is recalculated and previous write down is reversed. That means you have to reverse the previous impairment which you have charged either to the profit or loss or to the revaluation surplus. Both, we'll be talking about the both. If it was the impairment that has been recorded from the revaluation surplus, then the credit will go to the revaluation surplus. If that impairment was recorded through the profit or loss, that means the debit entry was in the profit or loss rather than the revaluation surplus, then the reversal will be the credit to the profit or loss. So impaired assets should be reviewed at each reporting date to see whether there are indications that the impairment has reversed. Like the asset on which you have charged the impairment, you have to see it every year annually to see whether those factors have now been reversed. If that is the case, then you have to reverse the impairment as well. A reversal of impairment loss is recognized immediately as income in the profit or loss. Now, if it was to the profit or loss, then the credit will go to the profit or loss. If the original impairment was charged against the revaluation surplus, then again the credit will go to the revaluation surplus. So carrying the same thing. If it is from the revaluation surplus, then credit goes to the revaluation surplus. If it is from the profit or loss, then credit goes to the profit or loss. So this is the idea behind that. Now, the main thing which you need to understand is the value of the reversal, the amount of the reversal. The standard has a specific guideline regarding that. First of all, I'm going to read these lines, and you will be able to understand these lines with the help of an example. Without an example, I don't think so you will be getting the idea. Okay, let's read these lines first, and then we'll be doing an example. The reversal must not take the value of the asset above the amount it would have been if original impairment had never been recorded. The depreciation that would have been charged in the meantime must be taken into account. Now, whenever you have a reversal of an impairment loss thing, remember, you have to calculate the carrying value now, and the carrying value had the asset not been charged any impairment. And you cannot take the asset beyond that. Now, again, I told you you have to do an example. Okay, we have an example over here. Boxer purchased a non-current asset on 1st January 20X1 at a cost of 30,000. Now I need your attention in this example because this is a very important concept. So the Boxer purchased an asset, the cost of which was 30,000 on 1st January 20X1. At that date, the asset had an estimated useful life of 10 years. We know that how to calculate the per year depreciation. The per year depreciation is cost divided by the useful life, how much it is, 10 years. So the depreciation per year is $3,000, right? Boxer does not revalue this type of asset, but accounts for it on the basis of the depreciated historical cost. That means this asset is on the cost model rather than the revaluation model. At 31st December 20X2, now how many years? 2 years after. The asset was subject to an impairment review and had a recoverable amount of 16,000. We know that whenever we are conducting an impairment review, what we are doing, we are comparing two things. We are comparing the carrying value with the recoverable value or the recoverable amount. Now, at what date we are carrying out the impairment review? On 31st December 20X2. That means 2 years have been passed since we bought it. So the depreciation that will be deducted and you will get the carrying value. Okay, 30,000 is the cost. Now you need to deduct the 2-year depreciation. So $3,000 per year into 2, it gives you 6,000. So 30,000 minus 6,000, the carrying value should be 24,000. Now this should be compared with the recoverable amount, and that is being given. So carrying value is more than the recoverable amount. That means the asset has suffered an impairment loss. Now what is this? This is 8,000. 8,000 is the impairment loss that has been suffered by the asset. 8,000. Now we have no idea whether this asset was previously revalued. So that means all of the impairment should be recorded directly to the profit or loss. So profit or loss debit by 8,000 and credit asset by 8,000. Fine. And now we know that once the asset has been brought down to the recoverable amount, now the new depreciation should be charged on the recoverable amount and the remaining useful life. Now the recoverable amount is 16,000 and the remaining useful life is 8 years. So now we will be depreciating it. The new depreciation per year will be 16,000, which is the recoverable amount, divide by 8 years, which are the remaining years, and you will get the per year depreciation of $2,000. Right? Now, at 31st December 20X5, now again, after further 3 years, the circumstances which caused the original impairment to be recognized have reversed. I told you that impairment is based on the indicators. Now, the thing which was based on which are the impairment has now been reversed, and now we need to reverse the impairment loss as well, and are no longer applicable, with the result that the recoverable amount is now 40,000. Now, first of all, we need the carrying value at this date. Okay, how are we going to do that? How are we going to do that? So carrying value at 31st December 20X5, and we have already discussed it, that once we have revalued the asset or we have charged an impairment loss, the new depreciation is being charged on the revalued amount or the recoverable amount. So the recoverable amount is 16,000 over here, and now you need to deduct 3-year depreciation, which was 2,000 into 3, and you get 10,000, which is the carrying value at 31st December 20X5. So let me just recall it what we have done. The asset was bought for 30,000, life is 10 years. We got a depreciation per year of 3,000. Okay, after 2 years, the impairment review has been conducted. So we need to compare the carrying value with the recoverable amount. Carrying value after 2 years was 24,000 and the recoverable value is 16,000. So because the carrying value is more than the recoverable amount, the asset has been suffered an impairment loss, which is 8,000, and this should be directly recorded to the profit or loss, as we have no idea, no information regarding the previous revaluation. Now, once the asset has been brought down to the recoverable amount, the new depreciation should be charged on the recoverable amount and the remaining useful life. So the remaining useful life after 2 years is 8 years. Now the new depreciation charge is 2,000 per annum. Again, at 31st December 2005, after further 3 years, they're conducting again the impairment review. And the factors based on which impairment was charged has now been reversed. And now what we need to do, we need to reverse the impairment loss as well. So the carrying value is 10,000 at that date. The student will make a mistake. Then what they're going to do is they take this carrying value again to the recoverable amount of 40,000, which is incorrect. You cannot do that because it's not the revaluation model, right? It's not the revaluation model that straight away you can take. Even in the revaluation model, yes, you cannot take that directly because there is the thing which we are going to discuss now. Okay, what we are going to do. So we need the carrying value had the asset not been impaired. We need the carrying value assuming if there was no impairment. So the cost was 30,000. The cost was 30,000 and per year depreciation was 3,000. What if there was no impairment? That means asset till now would have depreciated for 5 years. So that means 3,000 into 5, 15 minus 30,000 is equal to 15,000. So the standard says that you can reverse the impairment of only 5,000. You can take the asset to the value maximum where it would have been if there is no impairment, if there was no impairment. You cannot take the asset now to the recoverable amount, which is the new value. You can only take the asset to the amount if there was no impairment. That means the 5,000. Now the problem with this idea is that we originally charged the impairment of 8,000 to the profit and loss. Why we are only reversing 5,000? Like there should be the reversal of 8,000. We are only reversing debit 5,000 asset, credit profit or loss by 5,000. Why is that? Now this is the answer you will be getting now. What was the impairment loss in total which you recorded earlier? It was 8,000, right? 8,000 was recorded in the profit and loss. Now the depreciation of this asset would have been originally 3,000 per annum. But due to this impairment, you were charging depreciation of 2,000 per annum. Every year you were charging 1,000 less depreciation. So for 3 years, you charge less depreciation of 3,000. 3,000 less depreciation. Now, if you see the net thing is 5,000, that means you have reversed the impairment of 3,000 in the form of reduced depreciation every year. So that is why the standard is saying that you cannot take the asset beyond to the value it would have been if there was no impairment. And now again, we are going to read these lines. The reversal must not take the value of the asset above the amount it would have been if the original impairment had never been recorded. That means you cannot take the asset beyond to the value if there was no impairment. And the next lines are very important. The depreciation that would have been charged in the meantime must be taken into account, that every year due to this impairment, you are charging less depreciation of 1,000. Now this less depreciation of 1,000 every year was recorded in fact as an income. So that is why we are not reversing 8,000 directly. We are doing it 5,000 because 3,000 has already been reversed in the form of the reduced depreciation. So this is one of the most important concept within the IAS 36, which is reversal of an impairment loss. All right, now we have another example of the reversal of the impairment loss. On 31st December 20x2, an impairment review was conducted on a cash generating unit, and the result were as follows. Okay, we have the asset, which is the goodwill and the property, plant, and equipment. We know once there is an impairment of the cash generating unit, first of all, you have to charge it to the specific asset, then the goodwill, then other assets on the pro rata basis. So you see, the goodwill has been fully written off. And we know that once the goodwill has been written off, you cannot reverse the goodwill because otherwise it is going to be the internally generated goodwill. Once the goodwill has been written off, you cannot reverse the impairment related to the goodwill because it is going to be internally generated thing then. So the goodwill, it was fully written off, no value now. And then we have the property, plant, and equipment. The carrying value was 300. The impairment recorded is 120, and now the carrying amount is 180. At what date? 31st December 20x2, right? The property, plant, and equipment was originally purchased for 400,000 on 1st January 20x1 and was attributed a useful economic life of 8 years. Now we know the cost. The cost is 400,000. 400,000. It is going to be divided by 8 years, and the depreciation per annum is going to be, depreciation per year is going to be 50,000. So they conducted an impairment review after 2 years of the asset purchase. Now that means that the asset would have been 300. Now how this 300 has been calculated? 400 is the original cost minus 2-year depreciation, so 50 per year into 2. So that is why you got this carrying value of 300. And we know once the asset is brought down to the recoverable amount, the new depreciation is charged on the recoverable amount and the remaining useful life. So now the asset has been brought down to 180, which is the recoverable amount. Now the new depreciation, this is the recoverable amount, new depreciation should be charged on the remaining useful life. Okay, so after 2 years, how many years are left? Total were 8 years, 6 years are left. So 6 3 the 80, now the depreciation would be 30,000 per annum. At 31st December 20x3, the circumstances which caused the original impairment have been reversed and no longer applicable. The recoverable amount of the cash generating unit is now 420,000. We are not concerned with this amount. We are concerned with the carrying value now. Carrying value now means 31st December 20x3. And how this should be calculated? 180 minus 30. 1 year depreciation because it is being reviewed after a year. So that means carrying value now is 150. And now we need carrying value if no impairment was recorded. What it should be? It should have been 400, which is the original cost, minus how many years of depreciation? 3 years of depreciation, which is 50 into 3, 150. The carrying value would be 250 had there been no impairment. Now that means you can only record the reversal of 100. So what you're going to do is debit asset by 100 and credit profit or loss by 100. This is how you are going to record the reversal of an impairment loss. So the gain of 100,000 should have been reversed.